Hi everyone, it's Daniela Couillet here from Shareplicity, and today I'm very happy to have with me David Bassanese, who is Chief Economist from BetaShares, and we're going to be discussing a macroeconomic overview of both the Australian and US economies, and then we're going to be looking at some ETFs. So first things first, just to remind everybody, disclaimer, this is education, not financial advice. Please seek out professional advice before taking any actions. So, welcome, David. Thank you so much for joining me this afternoon.
No, great to be with you, Danielle. It's great to be connecting online in these days.
Exactly, and that's what we all seem to be doing a lot of at the moment. It looks like it's going to be going on for a while yet. So I had the pleasure of listening to a presentation that you did last week, an update on how you saw the impact of Delta variant on the Australian economy. And given that things continue to deteriorate in terms of the spread of the virus, particularly in New South Wales, maybe you can give us an updated view on how you see the economy moving forward over the September and December quarters.
Well, look, I think the December quarter is looking like an absolute, disaster zone, basically. We're looking at very weak growth. I mean, we've got lockdowns in New South Wales for most of the quarter. I mean, that's about 25% of the economy right there. Victoria's been on again, off again, and Queensland as well. So look, the outlook, the outlook for growth is quite weak. We're talking about something like 2.5%, GDP contraction, which is pretty significant. Now, I mean, the upside is that what we learned last year is that when we come out of lockdowns, when and if we come out, not if, but when, that, consumers do tend to bounce back pretty quickly, businesses bounce back. So we're hoping that's the same situation, that if we can come out of lockdown by late September, October, that the economy can bounce back in Q4. And again, if you look at the share market's basically not, it's not buckling because it's anticipating that recovery in the economy. And I think that's probably the reasonable case. It's just unfortunate, we're going to have to go through this very weak period of growth for a few months.
Do you think the Reserve Bank is possibly going to change tack as a result of these probably more prolonged lockdowns?
Yeah, it's been interesting because they had their meeting their last meeting, and many, myself included, thought they would at least, because basically the story at the moment is the RBA said we're going to cut back on our bond buying in September. And then when they had their next meeting, they actually said, even though New South Wales is in lockdown, we're still planning to go ahead with that cut back in bond buying, which is a bit of a surprise given the lockdowns. But I guess they were counting on this bounce back, wanting to look through the lockdowns. But I do think now, as this lockdown's got dragged on and it's spread to other states, look, come September, they will basically not cut back on their bond buying for what it's worth. I mean, end of the day, I think the macroeconomic impacts of whether they cut back on bond buying or don't doesn't really matter all that much. It's more presentational these days. I mean, they've already cut rates to zero and they can't do anything else on that front. Yeah. So the bond buying stuff, I've kind of cheekily suggested it's kind of theatrics. It's like being seen to be doing something when you can't really do anything else. And so that's the sort of situation the bank's in these days.
Yeah, and that was a really good point that you made in the presentation. The other thing that I was quite interested in is, because everything's relative at the moment, and we'll get to the US economy in a second, but you also touched on the fact that you thought that whole concept of the reflation of the Australian dollar, because a lot of people were talking about 80 cents, 85 cents, only, probably 2 months ago. We broke through 73 cents yesterday. And I think you were saying the other day that you actually see the Aussie dollar potentially remaining under weakness, under pressure.
Yeah, really what's been driving the Aussie dollar has been iron ore prices, relative interest rates, the US dollar strength itself. These are the factors that go into its direction. And funnily, earlier this year when iron ore prices were at $200 a ton, most economists' models, myself included, would have had it going over 80 cents, and it didn't. And that's because I think the market didn't expect iron ore prices to stay as high as they were. And so they have come back So the Aussie dollars sort of followed that as well. So I think there's a combination of things going on now. We've got China cutting back on steel production belatedly, but it needs to, because it's still producing too much steel, which is going to weigh on iron ore prices. As will Brazil finally coming back online with a bit more production as well. At the same time, I suspect the US dollar is going to start to strengthen, because we haven't talked about the US yet, but they are going to reduce their bond buying or do tapering, so to speak, which, if anything, probably will push up the US dollar a little bit. So I think the combination of forces suggests there's more downside than upside to the Aussie from where it is, even though it has fallen a bit already. But if you look at those forces, they all tend to be pointing in the direction of it going lower. And the fact our economy is currently in a hole doesn't help. And so that's not going to change for a while. So that's why I came to that. Again, as you said, a few months ago, I was saying I didn't see it going up over 80, and I did anticipate it would come back to 73 cents by year end on the back of iron ore prices falling. Now, it's got there quicker than I expect, but you sit here today and you're still, well, the forces doing that are still in place, so it's probably still going to head in that direction.
Yeah, and just to remind listeners, a weaker Aussie dollar is very good for some of our healthcare companies or health providers, some CSL, ResMed, those types of sectors where they generate overseas earnings. So just something to keep an eye on. Just in terms of if we move towards the US, and obviously we've got the upcoming meeting at Jackson Hole, and what I'm led to believe, the FOMC meeting in September. I understand this is one of the 4 important FOMC meetings that the Federal Reserve has. It's a meeting where they reset the dot plots as well as the forecasts.
Yeah.
So do you think that they've flagged it? Are they going to start to reduce the tapering, or start the tapering process, which is reducing the bond buying program? And if so, are we talking like 10 billion a month or 20 billion a month? Have you got any feeling for what you expect them to do?
What I think they will do is they will proceed with the bond tapering later this year. I mean, again, the timing, I used to be in a job where getting the day that they make the announcement right was really important. Whereas now I'm in a job where it's not so important, provided they do it, but they do it in a way that doesn't disrupt markets is the main thing. So whether they do it at Jackson Hole, which is the meeting of global central bankers, or they do it at the September meeting, my suspicion is that they're in no hurry to do it. So I don't think it's going to happen at Jackson Hole, which is later this month. It possibly could happen in September. And what I mean by happen, I mean they announce a timetable to start reducing the bond buying. They may not do it immediately at that meeting. They may say, yes, we agree that in 2 months' time, we're going to start to do it. And then when they make that announcement, they're not going to just stop overnight. They're going to, as you say, they're going to cut it back gradually over time. And so, I think the least painful way of doing it would be to reduce bond buying by 10 billion a month over 12 months. Which gets you from 120 billion a month, which they're currently doing, to 0. And therefore, they're set up to then raise rates. If they do that through the course of 2022, they're then set up to then raise rates as they're planning to do in 2023. So I think that's a reasonable time frame. Now, they may announce, so I think they'll make that announcement actually in November. That's my base case at the moment. So they will actually wait. And then it'll be something they begin early next year. And then it'll be gradual through the course of the year, designed to not disrupt the bond market. I mean, as some of your listeners and followers may recall, the taper tantrum of 2013, when the Fed last tried to do this and the market had a real hissy fit and interest rates went up and they had to backpedal. So I think they'll try to do it in a way that won't disrupt the markets too much. And they don't want to, because ultimately, the economy doesn't need to slow down too much. I mean, they've still got unemployment higher than they would like. There's an inflation issue which is largely short run. They don't see it as a longer run issue for the moment, which I think is, so as a result, they're basically unwinding some of the stimulus, but not in a way that they necessarily want to slow the economy or disrupt financial markets too much.
Yeah. It's interesting. There's such a debate still raging, whether inflation is going to be more embedded, inflationary expectations rise, or it's transitory. And obviously it'll take some time to probably play out, won't they, in terms of actually watching the producer prices come through, the CPI numbers come through. So it's an argument or a discussion that's not going to go away anytime soon. Is that how you see it?
Yeah, look, I think the way I ultimately see it is central banks are driven by the labour market, and what's most important is not, you know, whether prices are up at the moment because of hotel rates, or in the US there's a whole bunch of things that have pushed up prices in the short run. But provided unemployment is higher than you think is full employment, and provided you think wages growth, broadly speaking, is going to remain contained because the labour market isn't too hot, then anything pushing up prices in the short run is almost temporary by definition.
Yeah.
So that's the way I've come down it. So at the moment, again, as you may know, used car, I won't go into the details, but there's been a few things that pushed up prices in the short run in the US. But again, unemployment is above full employment. I don't think there's going to be a broad-based wage breakout anytime soon. So the Fed can look through that. And if something else were to materialize in the next couple of months, while the labour market is still in this sort of not too hot camp, then they'll look through that as well. So that's why I think ultimately investors need to focus on the labour market as a real guide for, you know, central banks' concern with inflation.
Yeah, and that's probably why the figures that came out today were quite interesting about probably the lack thereof of wage growth, despite the fact that we, you know, have a relatively tight employment market.
Yeah, so the numbers today were, so annual wage inflation in Australia is running at 1.7%. It was, the market expected it today to be 1.9, so it didn't even live up to that low expectation. Now, you know, the labour market's only recently tightened up. You know, it's come into 5%. So with lags, maybe wage inflation picks up. But again, I think there's a whole bunch of reasons, structural reasons that mean that we need a very tight labour market to get a decent lift in wages. And by tight, I mean 4%, if not lower. Yeah. So the good news is that the RBA can let the economy run hot, let that unemployment rate, if it can, go from 4.9 today down to 4, if not a bit lower. Unfortunately, in the next few months, it's not going to go down, it's going to go up.
I know.
Back up to 5.5. So so that's so it's good and bad. You know, low wages is you know, not good for workers, but it does mean that the RBA is going to keep rates lower for longer and let the economy run hot to ideally try to get the wages numbers up. So it's quite a, you know, very different situation than 10, 20 years ago when central banks were trying to do the exact opposite. Keep wages down and keep inflation down. Now it's the other way around.
Exactly. Yeah. I told the story in my second book. You know, people don't remember my mother used to put her cash on overnight deposit get 14% or something ridiculous. I mean, it's, you know, we're living in such different times. Yeah. Just on that, 10-year US Treasury, again, I thought it was quite interesting to just briefly touch on how you see that panning out over the probably peaking out 1.5, 1.75% over the next year or something, or end of year.
Look, I have a very simple model of 10-year bond yields, and it's basically based on the Fed funds rate, which is the US cash rate, and the market's expectation for what that cash rate will do over the following 12 months. Now, people debate what the Fed may do in 2023, 2024. To my mind, it doesn't matter for the markets because it's so far out, no one really knows. But for the next 12 months, markets can focus and worry. And so on the view that the Fed isn't going to be tightening in the next 12 months and the market won't be pricing that in, fair value for bonds is around about 1.5% in the US. And so that's where I see them averaging at least until early mid part of next year, because if the timetable is that the Fed raises rates in 2023, the market will start seriously pricing that in by the middle part of next year, and that's when I think the movements will come. So tapering per se, I don't see as having a big impact. So that's, you know, maybe that's the sort of simplified way I come down to it. I focus on what the market's going to think the Fed will be doing in a year's time to sort of sense where bond yields are going.
Yeah, it's always such a strange concept when people start talking about what's happening 2 or 3 years out. I mean, who knows, given that we've had a black swan event of a global pandemic that no one was talking about except for Bill Gates. just moving on then to valuations of equities, because again, you touched on something very interesting just in terms of we've probably got some more elevated valuations for shares at the moment, but given the bond yield, it's not looking too stretched. Maybe you'd like to comment on that.
Yeah, so I mean, the uncertainty of so the first and foremost, PE ratios, the so-called price to earnings ratios around the world are at 20-year highs. So the highest level since the dot-com bubble. Again, for people old enough to remember the dot-com bubble 20 years ago, the NASDAQ or the US market was trading at about 25 times earnings. Today it's at 22 times earnings. So that's high, but again, 20 years ago, interest rates were at 5-6%. Today, they're less than 2%. You factor that in, you get to a situation where the earnings yield of the market, less the bond yield, is at the lower end of its range of the past 10 years, but still well above its longer run average levels. So it's hard, firstly, it's hard to be definitive about what is fair value, given that measure has been all over the shop over the past few decades. And so you can't just look at the PE ratio without considering what's happened to interest rates. But when you make that comparison, that measure has varied so much over decades that you can't be definitive either. So my conclusion basically is that I think the market is broadly fair value, provided interest rates stay where they are. So I don't think the market needs to correct in a PE sense if interest rates, and again, my line in the sand is 10-year bond yields in the US, staying sub 2%. They say sub 2%, the US market can trade at a PE, around current levels, and then markets can still go up on the back of the earnings numbers that are coming through. So
and that's obviously predicated that the E part of the equation keeps working. And I guess when you
good news.
Do the analogy back to 2000, a lot of those internet companies were dubious at best with no earnings. And if you look at, I suppose, the stalwarts, the big FANG stocks, they're huge cash generators, and they're continuing to grow earnings, even if it is slower than what this latest second quarter results were. So if we have the basis that basically we're still in a sort of lower for longer interest rate environment, and we extrapolate that out to that awful those tags, which I don't really like, growth versus value. I tend to say it's better to look at companies that, because a value cyclical stock can also grow. But at this point in the cycle, do you have a preference using those tags more towards maybe the growth side of the market, or let's say the cyclicals, which were part of the reflation trade?
Look, I come down to, again, I think of it in terms of, I think of it in terms of sectors almost. Like people people look at the markets in different ways. Like you look at it from an individual company point of view. I kind of look at what are the sectors driving, the recovery. And so, as you say, really since the GFC, we've been in tech boom Mark II. So tech boom Mark I, as you pointed out, in the late 1990s, was one which initially was based on a lot of hope, and you didn't get the earnings growth, whereas this time around the earnings growth has been there. So it's been companies with real fundamentals. And I think ultimately that tech boom is going to continue. So as I've long said, what was doing well prior to COVID will continue to do well when the dust settles on COVID. We've had a bit of a value rotation in the short run, things like energy and financials that have done well, because they basically got smashed during COVID in the first. And so their rebound of the last 3 months or so is because they did so poorly during the downturn. So I see that not being start of a multi-year trend toward those areas. I still think it's a low inflation, tech disruptive type world, which favors a lot of the technology disruptive type sectors, internet, global, cybersecurity, we can go into it, but those sort of areas,
Oh, music to my ears. I couldn't agree more. So I was saying before, I've written a book and I spent 2 chapters on mega or secular mega themes. So I agree totally. And maybe that's a good segue to touch on some of the BetaShares and maybe also draw in the whole concepts of ESG, sustainability, decarbonisation. And it's really interesting because there's been 2 major deals in Australia in the last overnight, and a couple of weeks ago, Square buying Afterpay. So you're seeing that massive fintech disruption, which is what you were just talking about in the financial sector. And obviously this seminal deal from BHP, I believe, in terms of divesting, merging their oil assets. So there is, I think, a growing interest in how people can attain exposure to more sustainable investing, companies doing the right thing, as well as decarbonisation post that IPCC report. And to me, when you look overseas, there is a wall of money going into that sector. It's interesting. I think there's more announcements in the last 24 hours I've seen in Australia of similar types of actions, which is great because we need to move quickly. But I was having a look at 3 of BetaShares ETFs on these sort of themes. And the global sustainability leaders that you have, ticker code ETHI, the Australian sustainability leaders, I think the ticker code is FAIR, FAIR, and the Earth ETF, which is, I've just forgotten what it's called, the Climate Change Innovation ETF. So I just thought it'd be worth for listeners to understand how BetaShares actually works out what companies go into that ETF and what actual underlying indexes you're working off. What are the criteria?
Yeah, so really those 3 you mentioned, the first 2 are what we call, they're more ethically, ESG related. So that they do have an environmental aspect, but it's more basically with an ethical and social and governance perspective. So what we do there is we use quantitative criteria, like it's not subjective. And so we've basically sat down with an index, a group that then creates the index, to say what are the range of criteria of things that people don't really, from an ethical, social governance point of view, don't want to have. So things like alcohol, gambling, tobacco, fossil fuels, you name it, it's excluded from those ETFs. And so what we tried to do there is give it a broader range of screens to satisfy most people that have a ethical, concern. Because, I mean, what you don't want, and what we found from experience is that people care about being invested in something that they don't like compared to something they don't mind that's not in there, sort of thing. So the bias is to exclude most of the things that people worry about, because people are going to get more worried about something being in there they don't like than something not being in there that they wouldn't have minded it being in there, if you know what I mean.
Yeah.
So that's really the approach there. So it covers all those, the typical activities, plus fossil fuels, and things like gender diversity. For example, companies need to have a female board director, and if they don't, they're not in those companies. So that's
refreshing to hear, dare I say.
So that's the ethical approach. Now there is an environmental aspect to it, because another criteria is that companies need to be within their industry, within the top 60% in terms of carbon, having a low carbon footprint. So that's like a screen just to ensure that companies we are selecting, having met all these other criteria, are still relatively green in the sense of having a low carbon footprint. Now, the upshot of all of that, just incidentally, has been they've tended to screen out a lot of fossil fuel companies by definition, and screen in a lot of tech companies over the last few years. And so as from an investment point of view, they've done very, very well. So we've often said, you can profit from your principles. So ethical screening, by the nature of it, has actually been quite rewarding for investors. Now, the last one you mentioned, Earth, does something differently, is that it still has all those screens. So again, if there's someone producing electric vehicles but doesn't have a female board director or something like that, it's not going to make the Earth one. So it needs to meet all those other screens, but they need also to have a amount of revenue going from is directed toward reducing carbon emissions. And that's a very broad brush. And so again, some people approach it from investing in renewable energy or investing in battery technology. We've taken a very broad brush, and because the thing is, to get to net zero by 2050, a lot of things have to happen, not just renewable energy. You need to have electric cars. You need to have more sustainable food production. You need better ways to make buildings. And so we've gone with an index provider, identified activities that are helping reduce carbon emissions. And if companies have a minimum revenue exposure to those activities, they're included in the ETF. So that's sort of the way it works. It's again, it's a quantitative process. Once you identify the activities you think are helping reduce carbon emissions, and then companies that have a minimum revenue exposure to those activities are included in that ETF. So we liken it to it's a decarbonisation thematic in a way, rather than just renewable energy or something like that. So it's quite broad brush.
Yeah, and that's a really, really good point. I mean, I find it appealing because what people forget is that climate change is going to impact everything. It's just not, you know, one asset or whatever. It's all encompassing. And therefore, as you say, companies that engage positively to invest, to make the changes that they need to make, will also probably profit because they need to, because no one's just going to do this for free. But as you say, it's going to be across the board. It's you know, I always say it's interesting when super funds are buying very long dated assets, infrastructure assets. You'd love to be a fly on the wall to see how they're actually analysing the actual direct climate impacts, for example, of rising sea levels on Sydney Airport, or the effects on roads, etc. So that's excellent, David. You've really given everybody a great summary. Is there anything else in terms of your ETF products you'd like to touch on before we wrap up?
Oh, look, the one area, I mean, just going back to that thematic, I guess, in terms of growth versus value, and like the bigger picture, you know, as I said, what was doing well prior to COVID, I think will continue to, you know, generally do well as the dust settles. And so just, you know, the range of technology, disruptive technology exposures out there. And again, like, people can invest in individual companies, but the beauty, I guess, from an ETF point of view is if you identify a thematic, you can diversify away your company risk by investing in all of the companies in that area. And so we do have a lot of things like, you know, the NASDAQ 100, which gives you all the FANG stocks that people, you know, Google's, Amazon, Facebook's. Robotics and cybersecurity, a major boom area. Robotics and artificial intelligence, I should say, RBTZ. Cybersecurity as well, HACK is the code. So there's a lot of, if you look at the Australian market and you can identify great stocks, fantastic. But if you're looking at some disruptive growth, diversified exposure globally, you know, consider some of those. It's very easy to invest in those type of exposures now using ETFs. Yeah,
no, I couldn't agree more. And again, I discussed that at length in the book. And one of the reasons is I don't think it's you have these amazing growth opportunities, but to actually pick the winning stock that's going to be the winner, you know, in these major changes is actually not that easy, because there's a lot of competition, and almost by definition, the more the market is growing, the more competitors that come in. So I always say, if you can't find that winning stock, or you don't understand it enough, an ETF is a great way. I mean, you know, biotechs, cannabis stocks, even the cybersecurity space, I think it's much easier almost to buy the ETF, because there are just so many players and so many cloud, you know, endpoint providers, software providers, etc. So that is great. Yep. Sorry, did you?
No. I was just going to say one quick point. And the thing about indexing is people don't often appreciate is market cap indexing in a very dynamic area like technology is actually not bad, because if companies are doing well and their market cap goes up, the weight, and if they do badly, you actually get cut from the index. Whereas if you owned 5 companies yourself, you may not sell the company when you should have, whereas an index actually automatically does it for you. So
I agree with that. And that's the one thing when looking at the S&P. Kathy Wood from ARK Invest always says, well, the problem with owning the S&P is you capture all the old economy stocks, but you kind of go, but by definition, if the old economy stocks are not going to survive relative to the newer ones, on a market cap basis, they start to disappear anyway. It's only in that rotation trade that we had this year where you see the equal weighted ETFs for something like the S&P start to come to the fore versus the market cap weighted ones. But again, these are all really good things for investors to understand when you're buying an ETF. I always say they're fabulous products. There's so much to like about them, but you also want to understand what you're buying and kind of how the stocks have been selected, and are they the stocks, as you touched on, that they kind of want to hold. And in an ESG capacity, seemingly they get more upset about one that's included rather than one that's not included.
Yes.
Fantastic. Well, thank you so much for your time, David. It's been a great chat, and maybe we can do it, I don't know, 6 months or a year down the track.
No worries. Okay, great to be with you. Okay, bye for now.